Happy Monday. We're starting a new week in the markets, and unfortunately we do so in a very delicate international context. When geopolitics tense up, markets react immediately. And today, right now, the epicenter of that reaction is energy.
Right.
In the last few hours, the price of oil has become the absolute protagonist. I mean, the escalation of the Middle East conflict and the blockade of the Strait of Hormuz are generating a massive global supply shock, pushing prices over $100 a barrel for the first time since 2022.
It's an incredible spike.
It really is. And as we know, when oil moves like this, it's rarely an isolated problem. It's a signal of something deeper shifting on the global board. So today, we are going to explore exactly what that means for you as an investor.
Yeah, we've got a lot to get through today.
We do. We are synthesizing a really heavy stack of fresh institutional research today. Goldman Sachs, JP Morgan, Morgan Stanley, BMO Economics. Plus, we're pulling in government data from the EIA and real-time market reporting. Our mission here is to understand what this means for inflation, the stock market, and ultimately your portfolio.
And honestly, it's a masterclass in how interconnected everything is. We are watching a localized geopolitical event instantly rewire global finance.
Exactly.
But to genuinely grasp the magnitude of what's happening to your investments right now, we really have to start with the physical reality of the crude oil market today. Because the numbers flashing on the trading screens are historic, and they are moving incredibly fast.
Historic is putting it mildly. Here's where it gets really interesting. Just looking at the raw data from the opening bell, WTI and Brent crude futures absolutely exploded. We saw a 30% intraday spike.
30%?
Yeah, pushing prices dangerously close to $120 a barrel. To put that into perspective for anyone listening, that marks the largest one-week gain since 1979.
Wow.
A staggering 35% jump in a matter of days. You just don't see moves like that without something fundamentally breaking in the global supply chain.
No, you don't. And the thing that broke is physical access to the Strait of Hormuz. We've been in a state of de facto blockade there for 7 days now. And this isn't just some minor shipping lane where, boats can take a quick detour around a peninsula.
Definitely not.
The strait handles roughly 20% of all global oil flows. That is about 20.1 million barrels every single day.
20.1 million.
Every day. And on top of that, it handles 20% of the world's liquefied natural gas, or LNG. So when you pinch a hose of that size, the pressure builds up throughout the entire global infrastructure network almost instantly.
It has to go somewhere.
Exactly. And it's not just a matter of ships dropping anchor and waiting it out. The immediate physical fallout is hitting the actual production at the wellhead.
Because if you can't put the oil on a boat, you have to put it in a tank.
Right.
And from what the reporting shows, storage is filling up incredibly fast.
It's a massive infrastructural bottleneck. The onshore storage facilities in the Middle East are rapidly hitting maximum capacity. And when those giant tanks are full, you literally have to turn off the pumps.
You shut it down.
Yeah. You shut it down. We are already seeing the domino effect on a country-by-country basis. Iraq has slashed its output by over 1.5 million barrels a day.
Yeah.
Kuwait, which normally pumps 2.6 million barrels a day, and the UAE at 3.6 million, they are both curbing their offshore production and shutting down refinery operations simply because there is nowhere for the product to go.
Nowhere at all.
Qatar even had to halt its LNG facilities. You are watching millions of barrels of daily supply just vanish from the global market because the plumbing is backed up.
What blows my mind is that just a month ago, the headlines were completely different. Weren't we supposed to be heading into a structural oil surplus this year?
We were.
How did we get here so fast? I mean, you and I were just looking at research from the EIA and JP Morgan. And the baseline expectation was that prices were going to hover around $58 to $60 a barrel.
Yeah.
And that was because the United States, Guyana, and Brazil were all pumping at record levels.
Yeah, what's fascinating here is that the physical market outside of this specific conflict zone is actually incredibly well supplied.
Right.
There is plenty of oil in the ground and plenty of capacity to extract it globally. What we are seeing priced into the market right now isn't a long-term geological scarcity. It's an unprecedented geopolitical friction premium.
Let's break down that friction premium for a second.
Yeah.
That essentially means the world has enough oil, but the market is charging a massive penalty just for the sheer panic and the physical danger of moving it from point A to point B.
That's a great way to put it. The market is pricing in the fear. You have skyrocketing insurance costs for shipping companies, the logistical nightmare of rerouting vessels around the Cape of Good Hope, and of course, the very real physical blockade.
Right.
It's a sudden, violent shock to a system that really thought it had plenty of cushion.
So what does this all mean for the U.S. economy? We're looking at this sweeping spike, and the first thing that comes to mind is the word recession. We are definitely caught between a rock and a hard place here. Let's look at the recession math that the institutions are putting out.
The math is incredibly sobering. If you look at the models from Goldman Sachs and BMO Economics, every $10 per barrel increase in the price of oil shaves about 0.1% off of U.S. GDP growth over a 4-quarter period.
Which might sound like a small fraction to some people, but in an economy that was already cooling down, it's severe.
Very severe. Bruce Richards, the CEO of Marathon Asset Management, he put it very bluntly. He warned that if oil hits and sustains at $120, it equates to zero economic growth. He called it the literal trigger for a recession.
The literal trigger. And when oil hits $120, it's not just gas prices that rise.
No, it's everything.
Right, the cost of plastics, manufacturing, transporting every single good on Amazon, it all goes up. That's why growth goes to zero, companies freeze hiring and halt expansion just to pay for basic logistics. But of course, you feel that trigger at the gas pump immediately. The national average has already jumped to $3.45, and the prediction markets are betting it could cross $5 very soon.
Which is painful.
Super painful. When you look at the inflation impact, a sustained 10% increase in oil boosts headline CPI inflation by 0.28%.
Yeah.
And since consumer spending makes up 70% of the U.S. GDP, taking that much cash out of people's wallets just to pay for a basic commute is going to leave a serious mark.
It will, but there's an interesting psychological buffer at play first that investors really need to be aware of.
Okay, that's that.
Morgan Stanley's research points out that there is typically a 2 to 3 month lag before we see real consumption decline.
Interesting.
Yeah, initially households don't change their habits, they just absorb the shock. They put the extra gas costs on credit cards or they drain their savings to try and maintain their lifestyle.
So they just power through the pain until they can't.
Exactly. But after a few months, the savings deplete, the credit card bills arrive with high interest, and suddenly, discretionary spending just falls off a cliff.
Right.
People stop going out to eat, they cancel their summer vacations, they delay buying a new car or upgrading their phone. That's when the recessionary drag really grabs hold of the broader economy. And that's when you see corporate earnings start to miss expectations across the board.
Which brings us to the Federal Reserve.
Oh, yeah.
They have to be sweating right now. This is the definition of a stagflation nightmare.
It really is.
Stagnant economic growth combined with rising inflation.
It is the absolute worst-case scenario for a central bank. Normally, if the economy is slowing down and facing a recession, the Fed would cut interest rates to stimulate growth and make borrowing cheaper.
But they can't do that if inflation is surging because of energy costs.
No, they can't. Cutting rates now would just pour gasoline on the inflationary fire. Markets have already reacted to this reality. Just weeks ago, traders were pricing in 3 rate cuts this year. Now, they've slashed those expectations down to just 1.5. The Fed is completely boxed in.
So for your portfolio, this means the relief rally everyone was hoping for in growth stocks and real estate.
Which rely heavily on cheap debt.
Yeah, that's likely on hold.
Absolutely on hold.
The consumer is definitely the linchpin in all of this. We're going to get into some of the wild, extreme policies the government is considering to fix this right after a quick reminder.
Sounds good.
If you are enjoying what you're hearing today, we invite you to subscribe to the channel, leave a like, and comment on what topics you'd like us to tackle in upcoming deep dives. Also, in the description of this deep dive, you'll find a PayPal link if you want to support this project. Your contribution helps us keep making content like this. We only ask for the price of a coffee. Thank you for your support.
Getting back to the crisis, when the Fed is boxed in, like we discussed, the pressure shifts entirely to the policymakers. And the policy interventions we are seeing discussed in these institutional notes right now are nothing short of extreme.
Okay, let's unpack this because the panic at the policy level is palpable.
It is.
Over the weekend, G7 finance ministers and the International Energy Agency held an emergency meeting. The agenda: releasing an unparalleled amount of strategic oil reserves to try and calm the markets.
Right.
We're talking about releasing anywhere from 300 to 400 million barrels. That is roughly 25 to 35% of the total global emergency reserves.
It's massive.
And just the rumor of this meeting was enough to pull prices back down from that $119 peak into the $102 to $106 range.
It's an enormous intervention, the largest in the IEA's history if it actually goes through.
Yeah.
But if we connect this to the bigger picture, releasing reserves is just a Band-Aid.
Right. It doesn't fix the underlying issue.
Exactly. It doesn't fix the physical blockade in the Strait of Hormuz. It just buys you time, maybe a few weeks of artificial supply, hoping the geopolitical situation resolves itself. But the sources point to an even wilder policy option being considered,
Yeah.
one that really shows how desperate the situation is. The U.S. Treasury is reportedly considering directly shorting oil futures.
Wait, the U.S. Treasury is going to become a day trader? Are they really going to try and short the global oil market?
It sounds like fiction, but it is being seriously discussed right now.
Yeah.
It is a highly controversial, practically unprecedented move.
How would that even work?
The idea is that the Treasury would take substantial financial positions betting against the price of oil. They're hoping that their sheer financial weight would suppress paper prices and break the speculative momentum of Wall Street traders.
Let me make sure I'm wrapping my head around this. Imagine a town running out of real apples.
Okay.
The government steps in and starts aggressively betting against the paper price of apples in the stock market to scare off speculators, hoping the price drops. But at the end of the day, there are still no physical apples to eat. That's why analysts are terrified this could backfire.
That is a perfect analogy. You are attempting to fight physical scarcity, actual tankers that cannot move, with financial manipulation.
It seems so risky.
It is. Many analysts are warning this could backfire spectacularly. If the market calls the Treasury's bluff, or if the physical shortage just becomes too overwhelming to ignore, you further disconnect the paper market from the physical reality of missing barrels.
Right.
And that could lead to even more violent volatility down the road.
Unprecedented times call for unprecedented measures, I suppose. And as you'd expect, an economic shock of this magnitude is instantly becoming a political lightning rod.
Oh, without a doubt.
It's worth noting that the sources we're looking at show how instantly polarized this has become in Washington.
Yeah, the reactions are stark.
And just to be clear with you listening, I have to state right now that our goal today isn't to take a side or endorse either of these political views.
Exactly. We are absolutely not taking sides here.
We are just mapping out the reality of what's being said, because it directly impacts market volatility and policy direction. We are strictly and impartially reporting what is in the institutional sources to give you the full picture.
That's right. The debate is fracturing the political landscape, and investors need to understand both sides to navigate the resulting policy risks.
Precisely. So on one side, you have President Trump stating that the short-term spike in oil is a, quote, very small price to pay, end quote, for destroying Iran's nuclear threat and achieving peace in the region.
Right.
On the other side, you have prominent voices like economist Paul Krugman heavily criticizing the administration. He's calling this a war of whim, marked by a lack of planning.
Yeah.
And he's warning that this geopolitical conflict could be the straw that breaks the camel's back for an already fragile economy.
It highlights how deeply intertwined global security and domestic economics have become. For an investor, this level of political friction means that a unified, bipartisan legislative response to the economic fallout is highly unlikely.
That makes sense.
Yeah, you shouldn't expect any swift stimulus packages or coordinated fiscal rescue missions if the economy starts to crack. They're just too divided.
So moving from the political arena to the financial one, what does this all mean for your portfolio?
That is the big question.
Because while the politicians debate, global equities are panicking right now. We saw Japan's Nikkei drop nearly 6%.
Massive drop.
The S&P 500 is taking a significant hit. Ed Yardeni, a veteran market strategist, just raised the odds of a U.S. market meltdown to 35%.
Which is a huge jump for him.
Yeah. Meanwhile, the U.S. dollar is surging as investors flee to safety, and that strong dollar acts like a wrecking ball, absolutely crushing emerging market currencies like the Indian rupee, which just hit an all-time low.
It's a classic flight to safety. When oil spikes and growth threatens to stall, capital runs away from risk.
Right.
But it's not a bloodbath everywhere. There are always winners in any market dislocation.
True. So where's the upside?
Right now, energy stocks are the rare, blinding bright spot. If you look at companies like ExxonMobil and Chevron, they are surging.
Yeah, they are.
The broader energy sector is up 25% year to date.
They are essentially printing money at these price levels.
They are. They benefit directly from the geopolitical premium while the rest of the market suffers from the inflation it causes.
Which is a tough pill to swallow for consumers, but good for those portfolios.
Exactly. For an investor, having exposure to these large-cap energy producers is currently acting as a hedge. Not only are their stock prices appreciating, but their dividend yields become very attractive safe havens when tech stocks and consumer discretionary sectors are selling off.
So the million-dollar question for everyone listening, whether you are heavily invested in the S&P 500 or just trying to budget for the next few months, is where does this go from here?
Right.
How long does this last?
Well, the analysts at the major banks have mapped out a few specific timelines for us. The overarching theme is that duration is everything. If the conflict is short, say, resolved in the next few weeks, the consensus is that prices will likely fall rapidly back down to that $60 to $70 range.
Okay, because of that surplus.
Because the underlying structural surplus we talked about earlier will reassert itself. The world still has plenty of oil capacity once the shipping lanes reopen and the friction premium evaporates.
But what if it doesn't reopen quickly? What if the strait remains closed for months? We are talking about 20% of the global supply being choked off.
That is the nightmare scenario.
Yeah.
If the blockade drags on for months, Goldman Sachs projects prices hitting $150 a barrel by the end of March.
Wow.
And if the disruption lasts a full 3 months, their models suggest a catastrophic spike to $185 a barrel.
$185.
Yeah.
That would completely shatter the all-time record high of $147.27 set back in the summer of 2008.
It would. And at that level, you aren't just talking about a mild recession or a temporary dip in consumer spending. You are looking at severe, synchronized global demand destruction.
Meaning everything just stops.
Everything. That means airlines grounding flights because jet fuel is unaffordable, heavy industries shutting down factories, and global trade grinding to a halt. It is a full-scale systemic shock.
It's a stark reminder of just how fragile the global economic machine really is, balancing on a few narrow waterways and geopolitical fault lines.
It is, and this raises an important question, a final thread for you to pull on long after we wrap up today.
What's that?
If a single geopolitical choke point can instantly wipe out global economic growth and force unprecedented financial interventions, like a government literally considering shorting its own commodity markets to suppress panic.
Which is still crazy to think about.
Right. How will this permanently alter the energy landscape? Are we going to see a rapid, accelerated push toward non-petroleum alternatives and total energy independence, not merely as a matter of climate policy, but as a matter of sheer, unadulterated national survival?
That is exactly the kind of question that changes how you look at long-term investments. You start looking past the immediate panic and toward the industries of the future.
Exactly.
And with that, we reach the end of today's deep dive. We hope you liked it, that you learned something new, and that you'll join us for the next one.
Thanks for listening.
Thank you so much, and we'll see you very soon. Remember, in the description, you'll find our PayPal if you'd like to help us out. Thank you once again. Take care.